morning, everyone. My name is Oliver Blokland, Senior Conference Producer at Global Investor Group, and it's my pleasure to welcome you all to the ISF and ISLA Securities Finance webinar series. Today's session is entitled Industry Leaders, Perspectives and Outlook in an Exceptional Year. On behalf of myself and the team, I'm pleased to see so many of you have joined us here today. It's hundreds of people have joined. I'd like to thank our sponsors. Their logos were up on the holding slide. There are 17 of them, and we're so thankful for their continued support, and they've made this all possible. So please do go to the Content Hub at the microsite where you registered to learn more about their genuine thought leadership and white paper materials. In today's 1-hour web conference, we will have a panel discussion of around 50 minutes, and we have set aside some time for Q&A at the end and possibly some in the middle as well. We've already received a few questions for our panelists. If you do wish to ask a question, you can do so by clicking the Q&A button. So do keep sending through those questions for the panel, and we'll try to answer as many as we can by the end of the session. I'd like to thank the speakers and moderator for sharing with us your time and thoughts on the topics we'll be discussing today. This session is being recorded, and it is now my great pleasure to introduce Grant Davies, who will be moderating this session.
Thank you, Oliver. So first and foremost, I'd like to introduce our panelists, our esteemed panelists who will be joining us today. And I'll start with Ben Challis. Ben Challis is the Global Head of Trading Services across agency lending and collateral management businesses, which sit in Sec Services of the CIB at JP Morgan. Rebecca Floor is Managing Director and Global Head of Securities Service Sales and Head of Securities Service Americas. Matt McDermott is Global Head of cross-asset financing at Goldman Sachs. Is a member of the firm-wide and EMEA Asset and Liability Committees. And Matt Brunette, Matt is Global Head of Financing at Norges Bank Investment Management. His team is responsible for cash management and sec lending on a combined equities and fixed income portfolio. So I'd just like you all to just turn your cameras on as a first so everyone can start to see you, and unmute would be perfect. So welcome all. I'll give everyone a second to turn their cameras on so we can see them. I'd just like to ask everyone how they've been holding up initially. It's been a journey so far, and we've all gone through quite an experience changing priorities. So Ben, welcome.
Well, thank you. Keeping well, thanks, apart from the obvious lack of haircut and the disaster of homeschooling that I'm sure many people can relate to. Yeah, I mean, look, everything's changed, right? Everything changed in March. Financial services, like the rest of us, didn't really prepare what was thought to be a problem in the East, and then had to react incredibly quickly as reality bit. So maybe it would be useful just to start with some statistics to give some context, much of which will resonate to many on the call. At their peak, custody volumes were 200% of the normal. Margin calls and movements in the collateral management business also nearly doubled, whereas cash deposits went up by 2/3, all sitting on balance sheet. Closer to home, lending sales volumes were 10% higher than the high watermark set in 2008. And so really it's incredible to see how the market-wide infrastructure held up so well, and even more impressive when you superimpose the difficulties experienced by everybody in adapting to that new working environment. So our priorities clearly became, ensuring that our people were safe, ensuring that the connectivity and infrastructure was in place, both internally and externally, and of course, ensuring the service levels that we provided our clients were held at the same high level, especially given the understandable, high level of client queries. And so that really was achieved by the rapid adoption of new tools, whether it be Zoom, things like this, the adoption of e-signatories, etc., and really how we successfully leveraged the investment in technology and importantly analytics to kind of manage our risk exposures and business on a real-time basis.
Thank you, Ben. Welcome, Matt.
Hi.
Mr. McDermott, sorry. Oh, we've got two Matts today, one with small T, one with one T, one with two. So Matt McDermott, sorry, welcome.
Hi. So yeah, I mean, obviously sharing similar experiences to Ben, and I have got 21-week-old twins, so it's only been a challenge through the last few months. I'd say certainly, from the perspective of Goldman, and we kind of have seen kind of like a bit of a roller coaster, certainly over the last kind of 6 months in terms of financing. I mean, the year started out where we were kind of very kind of clearly just facilitating client demand. We were seeing kind of just a steady growth in reasonably kind of vanilla funding requirements. And then as we kind of hit kind of March, April time, obviously there's a huge amount of volatility that everyone's obviously very well aware of, where we witnessed a few things. Firstly, you know, to Ben's point, we saw a huge amount of liquidity drain out through kind of margin postings, particularly through the derivative business. We saw, you know, a number of different clients either term out or look to aggressively re-rate kind of transactions, which made them obviously significantly more expensive. And we also, you know, had the backdrop of a lot of corporates looking to basically draw down on their kind of revolving credit facilities. And so, you know, a culmination of all these, plus this is really the first real, I'd say, kind of dislocation in the market that we've experienced under the new kind of liquidity regulations. You know, we found that each individual operating company was kind of exceptionally well funded, but if you actually look at the holdco, we like to kind of, as a lot of banks obviously do, like maintain a certain level of liquidity. So there was a little bit of kind of work that we needed to do. And so, you know, we were quite aggressive and proactive in going out to source kind of additional funding across the secured funding markets, but also kind of in the wholesale funding markets like many other institutions as well. And then of course came, you know, kind of huge central bank easing, the market sell-off. And then all of a sudden this spike in need for liquidity resulted in us actually being in a position where we had significant excess. And so there was this kind of, you know, I said this orderly approach to really kind of reduce kind of the funding that we didn't need, which tended to manifest itself in the more liquid kind of equity funding, which is, you know, pretty obvious just given the equity sell-off. What we did see actually quite interestingly in facilitating client demand is kind of the need for kind of greater kind of funding in kind of the more, I would say, kind of perceived liquid assets, the kind of high yield, kind of non-investment grade credit, convertible bonds, where people saw a real spike in kind of yield and therefore, you know, an attractive kind of investment opportunity. And then as we've kind of meandered over the last kind of 6 weeks plus, we've actually seen kind of funding normalize, and we're not quite there, but our levels across the kind of secured funding piece are probably broadly in line with where they were kind of pre-March.
Thank you, Matt. And Rebecca, how does that, some of those points resonate with you during this period?
I mean, I think similar experiences. And what I would say is we started this kind of the adjustment to the pandemic by a working from home environment in March. And all at the time we had some of the most volatile markets I think a lot of us have seen. Not only that, but also the adjustment to those. So all of the policy changes were way swifter than even we saw perhaps during the financial crisis. And I think, you know, what was really kind of surreal to me, certainly, but I'm sure to a lot of us who, you know, had maybe not done so much working from home in the past, was we were experiencing this all from the comfort of our own homes, or I guess I would say the silence of our own homes, in terms of there was no chatter on the floors and nothing, you know, for us to actually just take this in. So, you know, I think definitely similar experience there. But what I would say is, I'll echo some of Ben's comments, which is what I think the surprising part was how swift the reactions by regulator central banks, like I mentioned, suspension or of some of the short selling, different kind of reactions like that. But I would also say what was surprising in a positive way is how technology did not let us down especially during the initial phases and since then. And I think today is proof positive of another example of that. But I think that's a good theme going forward when we talk about how do we adjust. I think the fact that the technology was reliable and now has opened up a lot of new avenues for how we do business going forward.
Mr. Brunette, you've had some problems with video this morning, I see. I don't know if you can hear us.
I can now. Can you hear me?
We can hear you perfectly.
Yeah.
Welcome.
Yes, thank you.
So look, I mean, from the coalface, from the beneficial owner point of view, look, I mean, you've listened to our panelists. I hope you've been able to hear them right now. But your thoughts, I suppose, just initial perspective would be great, just on recent volatility.
Well, I think my priorities are sort of business related, anyways. In terms of volatility, it certainly, if nothing else, made us rethink how we price risk in the market. And I would say, as an example, we previously ran our business assuming we could survive a 10% daily market move on the failure of a counterparty in a crisis. I think that number is more like 20% now. So the interesting thing in the secured finance market is spreads come down pretty significantly and steadily going into the crisis. So your compensation for the same risk that you're taking has certainly decreased. So I think, we certainly in Norges Bank, and I hope the industry sort of rethinks how they price that and how they're being compensated for that same risk.
Thank you. So I think that's certainly something we'll dig into a little bit deeper sort of later on in the discussion. So what I'd like to just pick on to just a little bit as we progress is just a bit on what Rebecca just mentioned on impact on office and client relationships. I mean, the office footprint is changing, of course. And look, let's face it, I mean, there's two things. Office culture is important. Relationships across our internal organization are important, but incredibly important during market stress. So short term, I mean, I think we've got relatively deep relationships, but how do we cultivate our office culture? How do we maintain those relationships on a longer term basis? I suppose we stay in the sort of holding period position we are for a period of time. Matt, can I ask you, I suppose, from a financing point of view, first off, I mean, relationships are incredibly important during times of stress.
I think that's exactly right. I mean, I think the ultimate answer is adapt. And I think, certainly from all the many different distribution channels that, my team leverage across the organization, we haven't really missed a heartbeat in terms of client connectivity. So I think, to your point, those short-term relationships, kind of not short-term, those relationships in the short term, are stronger than ever. And I think with, WebEx, Zoom, all the different kind of mediums to continue kind of interaction, in a funny sort of way, you're actually kind of, your connectivity is ultimately a little bit better because, there's this vast Zoom fest that everyone's kind of talking. And so you can seamlessly be talking to kind of someone one-to-one, in Asia, in Europe, and then in the US. And so you do actually kind of maintain a very good global perspective of kind of what's going on and good connectivity across the piece. I think the longer term point is an interesting one. And I think there's nothing like the face-to-face interactions. And I think people will definitely warmly welcome back the ability to kind of interact at, be it conferences or kind of in the office. I mean, we're starting to see a trickle back into the Goldman office now. I mean, it's probably 20-25%. And you do kind of really do, kind of appreciate how much you've actually missed that interaction. But I think people do adapt. And I think, if it was a position where you were going to continue to work from home, you would continue to kind of build and leverage the skills that you developed at home to kind of grow your kind of network and ensure that, you're doing your job in the most optimal and efficient way.
Thank you. And I think, I mean, certainly we're all feeling it. So, and Rebecca, when we talked, you mentioned office culture and maintaining that during this period. That we've also seen people hiring people during this process. How do you instill that office culture?
Well, I think too, on the one hand, in a positive way, well, no, I won't say positive, but on the one hand, I would say this has been the great equalizer, right? So we are nearly at 100% working from home. When we had our first kind of Zoom session all together, you're seeing into people's homes, you're seeing, and in my case, my kids popped into the room. So, you're seeing things like that. And I think because all of us are in the same situation, it's been a very humanizing event. And I think so from a relationship standpoint, there's a positive element to that. Things are real and you are really asking how people are doing, how their health is, how their families are. And you're a bit more exposed to that than maybe you would have been. So I think there is a positive element to come out of that as we're WebExing and Zooming and Skyping into people's homes, right? But on the other hand, and I think, when you've already established relationships, we figured out how to maintain and how to keep those kind of moving forward. I think the big question is, and I've been shocked by how much hiring I have seen going on during this, is new kind of working arrangements, training, things like that. How will that be going forward? And I think there will be a lot of emphasis is how do we pivot from here to what becomes our new kind of business as usual when it's not 100% working from home, when we're not all in the same situation, when you have some people returning to the office and others who can't for health reasons or dependents health reasons or things like that. And it'll be kind of up to very good management and very good technology to make sure that we keep everyone on equal ground.
Yeah, management styles will certainly need to change. It's interesting. So,
Yeah.
and Ben, you also mentioned, I mean, the opportunities it brings too. Yeah. So, diversity is clearly one of the things we're focused on. This could bring opportunities, I think, for organizations to adapt and change.
I agree. I think we really have got to use this as the catalyst for that change. And it's fair to say that some of the taboos have been broken, right? The lack of flexibility that we've typically shown in this industry, especially perhaps on trading desks, where you've got to be there versus, through trading hours, versus the flexibility that we've now got, and this ability to promote dynamic working, hopefully then should lead to more people willing to apply for those type of jobs, where versus in the past where they thought, oh no, I'm just not going to be able to flex into that way of working. So I really think that is going to be a real driver for change. I'd like to pick up on something Rebecca said, because it's something that we really get concerned about, is the inequality that could stem. And that's why I think the point's really well made around the emphasis on good management, around having certain people grouped together, perhaps back in an office, and then certain people working remotely still, and maintaining that level of connectivity and inclusivity as we adapt to the future working arrangements. So that's something that we're putting a lot of kind of time and effort and emphasis on looking forward.
I would just say, to add to that, Ben, I think, we've talked about the themes of technology, but I think it's certainly when you get into, talking about diversity, and also how do we take this going forward with relationships with our clients. And Grant, I think that was one of the parts of your original questions, right? I think both go hand in hand, right? It's really, we've used and taken advantage of all of the technologies to kind of operate up till now. And now how do we really take that going forward and take it to the next level? So Ben, I think having video conferencing in all kind of conference rooms at work, on everyone's desktops and things like that, will definitely be key to being able to include those who are working from home. And yes, I do think it has to be positive for diversity. And can we kind of roll this out in a standardized fashion so that we can use it to communicate kind of even more face-to-face via screen, at least, with clients. And I think that embracing the diversity side of that should make us look, kind of like our clients as well, in terms of the diversity that we see with clients, and being able to kind of really, really build those relationships, again, starting from a little bit more personal front.
No, I think that finishes nicely, I suppose, on the experience of working in this environment. I think there's a lot of positives come through that. We talked about breaking some taboos, and I think there's certainly been some challenge. I mean, sec lending has a lot of publicity. Some of it's negative, some of it's more positive. I think we've seen some examples of that. Just talk about specifically the sec lending environment, I suppose, where we talk about sustainability, ESG. I think let's talk about Wirecard. Let's throw that name out there a little bit. Yeah. So the role our markets play is really important, and I think Wirecard as an example, certainly. And Matt, you've published an article recently. Lending is good from Norges. So I think Wirecard can sort of demonstrate lots of reasons why lending is good.
Yeah, I mean, I don't know if I can comment on individual securities, because we have a universe of 9,000, but we're certainly big fans of. Well, let's be honest. We lend because it creates a revenue stream for the fund, right? But we're also firm believers in short selling as a necessary component of well-functioning markets. So it's, in terms of liquidity, price discovery, and I guess you're saying the pressure that can be put on management to sort of reveal frauds, and I wouldn't disagree with that.
Okay, I mean, and look, I'm gonna grab a question while we're talking through this, because it kind of resonates with some of the points we were talking about pre this panel. And the question that's come across is, do we think the regulators got it right during the pandemic? We've talked about short selling bans, and of course, there's disparate views on there. Ben, would you think that they had impact? Do you think they were necessary?
Well, I think all the empirical evidence points to the fact that they don't have the desired impact. but it's clearly an example of where, you know, regulation and politics overlaps, and therefore, you know, we continue to see unfortunate knee-jerk reactions. But, you know, from our point of view, we have to separate the securities lending aspect to the short selling ban. You know, clearly you often borrow securities to support short selling, but not always. And I'm sure, you know, Matt will tell us lots about, you know, why there's, you know, inherent liquidity reasons that you borrow securities. And so certainly from a revenue point of view, it's going to have had some impact. I think it's important to also point out that the negative client reactions that we saw, and I think, you know, Rebecca would agree with this, was relatively limited in terms of people limiting the scope of their program or suspending their program altogether. And so, you know, it's clear that, you know, that message is starting to get across at least.
Yeah, I mean, I think if you bridge into both themes, so short selling and the ESG kind of aspect of things, I think it actually can be a positive thing. And I think, you know, all of the markets we saw implement short selling bans, I think the European, there were kind of 6 markets in Europe and 5 in Asia, and the European ones reversed, you know, in fairly short order, I think. But I think, Ben, to your point about seeing negative client reactions, I think you actually see, I don't know if opportunity is the right word, but kind of people using the short selling to kind of support some of their ESG goals as well. And I think that will be an interesting theme going forward. I think one other thing, we published a research piece seeing the shift of what ESG, you know, what factors go into this in terms of people determining their guidelines for that. I think that will be something interesting to see. I think going into COVID-19, we saw a lot of kind of environmental participation in the guidelines. And now you see a lot of focus on what are companies doing for employee wellness and things like that. So I think seeing that shift will be interesting as well. And certainly a lot of people taking action, you know, via short selling and other pressures they can put on corporations to comply with these ESG goals.
Yeah, and I think one byproduct of that is obviously going to be a differentiation in kind of funding costs for kind of those perceived to be kind of environmentally or socially kind of acceptable and those that are not. And I think it's just slowly starting to manifest itself, but it'd be interesting to see kind of how that plays out kind of over the next 6 to 12 months.
I think maybe, can I add one point to that? Now that I've got the proper background here, I'm
and you're the right way up now as well.
All right, okay. Can we start over? No. So you mentioned a couple of things in the ESG and sustainability. There's also thrown in some comments about lenders leaving the market. We missed an opportunity in March in the big Asia conference in ISLA to talk about one of those lenders and the reason for that. But we had others from, so Japanese lender, significant in size, and then some Australian lenders sort of at the cusp of the crisis. And one of the things they mentioned was the G in ESG. So, and this is just things that I've gleaned. I haven't talked to them. I don't have any more information than I've read in the papers, but they put out this idea of, we don't know what borrowers are doing with our stocks. So we lend mostly to prime brokers that are servicing the short sells of their hedge fund clients. And we assume that that goes to a short sell. But they sort of brought up the idea that maybe there are some funds that are borrowing shares to vote against our best interest. And I think the industry sort of needs to answer that question to say, is it possible to borrow to vote? Does it happen? If not, what are the controls that are in place to prevent that from happening? So I think if we don't want more of that coming in the future, that needs to be addressed.
Really strong point, Matt. So I'm going to put that out to Ben, I think, just from your role. How do you see that messaging being controlled?
Well, I don't think there's any systemic way to do it other than to continue to message that through. You know, it's part of code of conducts that ISLA have put out. It's part of code of conducts that the Bank of England, and I'm sure other, you know, central banks have put out, that, you know, that borrowing to vote is a taboo practice. But given the, you know, the legal mechanisms that we transact under, then clearly it is possible. So, you know, the governance of that is going to be through that continued education, but also by creating perhaps some more information for the clients and showing them the value of the securities on loan versus the contentiousness of a vote, for example, and then therefore giving them an informed decision-making process with which to recall their shares if they want to show good governance by attending the vote versus foregoing the revenue that's on loan. So I think that there's some smart technology and information analytics that can be incorporated into lending a little bit more deeply, in my view.
I think that's the key point, right? It's transparency, actually kind of knowing kind of where your stock's going and looking and assessing the options that you have.
So look, so I just pause on that for a moment and pick up on one point you made earlier, Matt. So we talk about ESG governance in lending. Financing is, I suppose, and I think you mentioned it, is slower to adopt, but is starting to see that. Are you seeing any impact of that at this point in time? I mean, I suppose, look, so I think ISLA are very keen on, they've got a Council for Sustainable Finance now within ISLA.
Yeah, which I think, yeah, sorry.
Is that something you're seeing discussed more and more? Are you seeing the differentiating rates come through?
It's certainly been discussed, significantly more. I mean, there's obviously a huge amount in the media, from a variety of different institutions, including obviously Matt's. And so, yes, it's definitely kind of one of the topics du jour. But in terms of kind of pricing differential, we don't actually kind of see that manifest itself at this point in time. I mean, there is certain stocks that obviously you see a differentiation, but I think to me, once you actually see more people adopt kind of a more ESG friendly kind of, say, tri-party profile, and more people kind of gravitate towards that in the way that they were doing with kind of LCR friendly collateral profiles, then I think you may see kind of a pricing differential kind of be more stark. But at this point in time, I don't think we've seen any material difference.
See, I don't disagree with that, Matt. The challenge, and this will be music to Andy Dyson's ears, assuming he's listening, is around standardization, given that when you're talking about financing, you're either talking about assets that are governed by an index or a sector, etc. Here, because there's no necessary standardization across the verticals of the S, the G, something that's a G for you or a negative G for you is not going to necessarily be a negative G for somebody else. So, I'd love to hear your thoughts around how we solve for that.
That's me.
Sorry.
Is that to me or is that to Matt Brunet? But I think the point's a very valid one. I think it's very difficult, and I think you can proactively, probably create what you perceive to be kind of, a friendly ESG profile. But to your point, Ben, I mean, that's certainly not going to necessarily apply to all. And I think, Matt obviously, has his own kind of profile with specific kind of companies that don't feed into that, and so that would be potentially very different to somebody else's. Yeah.
I'll make it easy, Mr. Brunet. Rather than Matt, I was getting confused. Your thoughts would be interesting here. I think, look, I mean, you mentioned price differential earlier on for certain transaction types, and I'd like to dig further into that a little bit in a minute. But just from an ESG point of view, do you see that something that's going to change? And picking up on Ben's point on standardization, how do we evolve that?
Yeah, I'm not certain I'm going to agree. Standardization is maybe works for the industry as a whole. It doesn't really work for Norges Bank because there's professionals here that have their own opinion on what are the factors that we want to capture in an ESG portfolio. And then as a securities lending manager, I take those as given and I adjust the collateral universe to the investment universe that we face. So I think the question to Matt McDermott was, does this start to change the cost of financing for those companies that aren't viewed as ESG? And I would agree. I think it's probably a bit too early for that. I don't think we've seen that. It certainly affects what we have seen is if we make a lot of adjustments to our collateral sets, that's quite difficult for the borrower community and the tri-party agents to handle. So it's problematic unless it's sort of a static set of factors and a static set of securities that you want to finance. But I don't think that's embedded in the cost of companies' finance yet.
Okay, and look, so and you picked up on quite a key point there. I mean, technology is part of this challenge. Let's move on into that a little bit. So technology is key for a number of factors. Tri-party is clearly at the forefront of that, Ben, and that's your other hat here. Does technology infrastructure need to continue to evolve to meet these challenges?
Well, yeah, no doubt at all. You know, the tri-party platform is a technology platform at its heart that, you know, that ultimately sits in a custody bank because of the safekeeping aspect. But, you know, it's about being connected and then about being efficient. And as the market participants evolve their different efficiencies, you know, then becomes trying to solve for the output of those efficiencies with which to fulfill the collateral obligations. And that's the challenge ultimately there, because it comes back to exactly what we've just talked about, actually, that you know, we sit in the middle as a facilitator of the collateral process, but where the two sides can't necessarily agree, you know, what is eligible as we evolve this ESG piece. So if Norges say that, you know, a particular security is not eligible, that's fine. We're able to, you know, to implement that down to the ISIN level, but then that becomes arguably problematic for someone like Matt, who is posting the collateral, and then having, you know, different requirements that aren't index or list based with which to govern his collateral obligations. And so, you know, as I just think that this world will become ever more complex unless there are some elements, and I totally take Matt Burnett's point in terms of, you know, it being a differentiating factor, but it also becomes a tougher one to implement by, you know, by the technologies, arguably.
Yeah, and I think that drives from, and not comments in a previous panel where people talk about standardization there, and it's difficult to price comparable risk if you've got such differentiating factors, let alone counterparty collateral sets, which are so, I suppose, very different in nature. Rebecca, I mean, how do you see that evolving from your program? Do you see sort of a lender role adapting further?
In terms of pricing risk? Sorry.
Yeah, sorry,
yeah.
In terms of pricing risk.
I don't know if I see, so I think that, you know, the agent lender, you know, we're kind of in the middle there already. So, but I do see all of our roles to continue to evolve. So I know we had a bit of a discussion. I think it was more from the beneficial owner side in terms of, you know, the price of risk, and that I think as things evolve, and we talk about standardization, are there more, you know, kind of, are there certain things that can be standardized, and then those that aren't, are we pricing that, you know, correctly? I think the more kind of one-off trades and things like that, I think that'll be the question. And I think that's how I'd like to see us kind of embrace the two sides. Certain things that can be completely standardized or make use of other venues that are potentially already there, but we haven't as a wider industry kind of adopted. And then, you know, kind of then pricing the risk appropriately for things that fall outside of those kind of standardized offerings, if you will.
Yeah, and yeah, I think you're absolutely right. So from Matt Brunette, I mean, look, you've mentioned this a number of times. During the volatile period, pricing got interesting, and I think almost encouraging you to take on transactions, but with the reward so low, and return to, I suppose, a new normal that is less encouraging for you at this point. Just picking up on Rebecca's comments, and I suppose I'm pushing the standardization piece again a little bit more, is are there different trades, are there different parts of transactions that you would be prepared and need to consider where, you know, you probably do need to get paid a little bit more for that risk? And then I'm going to throw it to Matt, because you're the guys that are going to have to pay for that from a financing perspective.
Yeah, sure. I think that's right in my wheelhouse. So, you know, I think as I kind of mentioned earlier, you know, spreads or pricing in securities financing transactions have steadily gone down into a crisis, into the crisis. And I think it's, you know, we've been kind of trying to beat the drum on that for the past year, that we think the market is mispricing risk. We think hedge funds have been quite successful in pushing spreads tighter and tighter. And it seemed to me that March was potentially a turning point, where that started getting a bit more interesting, where it seemed like the market started to drastically reprice risk. So we've been very conservative, kind of, saying no to a lot more trades than we said yes to over the past year. And then suddenly March, there were real trades to do again, but unfortunately it only lasted 2 or 3 weeks. On the standardization point, I think standardization is great. We want to standardize documentation. We want to standardize best practice. We want to encourage as many people as possible to participate in this market. But standardizing risk seems probably the wrong way to go. I think individual institutions need to come up with their own ideas on how they price risk, how they price these transactions, because there is risk in there at the end of the day. And that risk has changed. So you had, I think, 8 days in March where the S&P traded more than 5% absolute price movement in a single day. That's much more volatility than we've seen in the past 10 years. So maybe those small, tiny margin trades that have tail risk at the end of it aren't worth doing, would be my reflection.
Thank you. And Matt McDermott. So, and I'm going to pick up a question because I think it's the right time to bring it in, is from the audience. To what extent has hedge fund behavior changed during the past 6 months, during this period? Do you think, I mean, look, let's face it, people like to push pricing down to as low as it can. It keeps their business reasonable. Do you think there's going to be more acceptance of risk price trades that Matt refers to going forward? Or do you think there's always a delicate balance to strike?
I'll answer the question, but I'll also just respond to Matt's point as well. And I think, Matt, to be fair, is probably right in his thesis that, the risk reward dynamic did change quite markedly kind of in the middle of March, but then obviously there was a huge amount of kind of central bank easing, which kind of changed the dynamic somewhat. And so, Matt's obviously a bit of an outlier in terms of kind of how he thinks about that relative to kind of access, say, someone like us has to the market to source liquidity. And so, we then obviously naturally will go to kind of where we can source funding more attractively priced. And there is a lot of access, quite quickly available, kind of beginning of April. Specifically on the question about hedge fund behavior, I would say one of the things that we did see was probably a migration away from kind of the more vanilla assets into kind of, and I mentioned this right at the beginning, kind of high yield assets, non-investment grade credit, convertible bonds, because there the risk premium was just very attractive relative to what were very expensive financing levels, but just the being able to lock in the profit was far more significant than, the opportunity set for, like I say, the more vanilla. And actually, kind of, I would say the last 2 weeks in March, you actually saw that manifest itself in just investment grade credit. I mean, there was over $1 trillion of investment grade issuance through March, April, and certainly kind of as it kicked off, levels were very elevated. And so there was a very attractive opportunity for perhaps investors that wouldn't ordinarily kind of entertain that space. And, you saw some of the hedge funds come into that. So I would say, certainly at the beginning of the year, it felt like kind of more kind of vanilla type funding requirements. And then I think through kind of the more volatile periods, people were taking advantage of elevated kind of risk premium and really locking in some attractive levels, albeit at kind of higher financing costs. And we're probably seeing that to a lesser extent now as well. And then the other point I'm going to make, was on just going back to what Ben talked about in terms of, basically tri-party collateral profiles and the standardization. I think standardization is just a theme across the market that we all kind of agree to. And I mean, I would think that, you take the kind of 4 prominent tri-party agents, all have different kind of collateral profile forms, and it's all, kind of slightly different. And so it does kind of make life a little bit, difficult if you're trying to price each individual one. And so I think the work that's been done, on the common domain model, by Andy Dyson and team, I think will be hugely valuable on the forward, and hopefully that will enable that whole kind of market just to kind of create a standard kind of tri-party profile, which, from someone like us, would just be a little easier to price, and hopefully just be more kind of fungible as well.
I think that was my point, and maybe I didn't articulate it well enough, that, you know, absolutely that non-differentiated technology layer is what I think really needs to be focused on and improved in short order. And that's the standardization you mentioned. It's the fact that, you know, we can't get on Zoom calls to connect to WebEx calls to connect to Cisco, you know, that kind of stuff. You know, we've had tri-party conversations on intraday pricing. Again, easily solvable, but you need to just answer some really basic questions actually around, okay, what's the timing of it? You know, and what reference point are we taking? And similarly, you know, I think where you're starting to think about differentiated haircuts for assets, it's something that we talked about previously. You know, you have to have a definition of what the asset class and the sub-asset class is. And it's that level of standardization that I was really trying to promote, attacking in short order.
Completely agree.
I think, and certainly in a financing trade, it's about 23 different points of negotiation. Like I say, taking away some of those unknowns at that point would be important. We talked about connected technology a little bit. I think technology has developed in isolation to solve certain things. And look, I think I've been a tri-party guy for a long time. So looking at how it evolved from flying pieces of paper around the world to sign them to be able to trade on it, you start a trade and maybe in a month's time you get it done. Yeah, so those times have moved on, I think. But I think more to be done though, yeah? So, Matt, just one last point really before we move on is, we mentioned one of the biggest challenges, and this is a pre-call discussion we had, it was one of the biggest challenges that a prime broker has during periods like this is market volatility, assets drop in value drastically. So it's a challenge at that point. So you've got some great trades on, you've got some term commitment, you've got assets that you've got liquidity, but your challenge then at that point is just a valuation challenge, full stop. Yeah. So you mentioned high yield, called bonds, equity markets getting decimated. Are there things that we can do to create more stable environment for that going forward?
Yeah, look, and I think this is something, you know, Matt Brunette has obviously highlighted on a number of different occasions, and I do kind of sympathize, and I think, you know, firms do try and obviously kind of project their funding requirements and are also bound by very, you know, kind of stringent liquidity regulations. And so I think one of the things that we've spent a lot of time here is looking at kind of, I would say kind of equity kind of linked funding trades and contingent funding trades, because that actually means then at least you're more correlated with kind of moves in the equity markets, which is the bulk of our secured funding requirements. And similarly, where you have, you know, contingent funding trades, you can kind of dial up and dial down, you know, kind of as and when you need the liquidity. And so the yield may not necessarily be kind of as attractive, you know, for the entirety of the trade, but it does mean that you can keep it on, you know, kind of for kind of the volatile periods and then, you know, beyond that. And so, you know, that's something that we have spent a lot of time just working out kind of the dynamics of the contingent funding trades. Performance risk is a big consideration, you know, because you don't obviously be beholden to your client to give you the liquidity. So you need to make sure that the dynamics are right, but that's kind of certainly where we see certainly more of our focus, and just, you know, really emphasizing the kind of the equity linked kind of funding products also, I mean, for obvious reasons.
So look, and look, interesting discussion, and look, contingent funding could be, yeah. I mean, I'm interested in how that progresses. I mean, Rebecca, I mean, you're still, I suppose, you know, you've been in the broader industry for a long time, but I suppose SEC services or SEC lending, you're a relatively newbie, yeah. So hearing some of the discussions, looking at the technology challenges, are there things that we can learn from, I suppose, from your previous experience, things that you look at and go, you're all mad. Why are you not connected? It's been going crazy for a long time.
Well, I mean, I think just interestingly, we've used the word standardization quite a bit, right? I think we're in the middle of implementing SFTR, or kind of the broader industry is, right? And I think, you know, if we look past, just as an example, if we look past the initial kind of technical burden of implementing that, there are a lot of benefits around standardized data, as well as greater transparency to the market. So I think, you know, kind of what I would say coming in and seeing, again, just the difference of, you know, we learned how to operate in a completely remote environment. We've used technology somewhat reliably now. You know, we might have some problems with Zoom here and there, but, you know, overall, I think operationally, we use technology very, very effectively. So I would say going forward, what can we embrace in terms of, you know, the consortia that are out there, the participation, the tri-party kind of schedules, different things like that. And then I think, taking it to the next level, you talk about transparency of data. We talked about voting, and things like that. There are new consortia like proximity and things out there for voting. I think embracing some of those as an industry. So I think we've made individual kind of decisions, corporation by corporation or business by business. And I think, having some of those be embraced more broadly by the market will be kind of a positive to come from all of this use of technology in the short term. So I would say, kind of what I would hope is that we embrace kind of this mentality and momentum we have in terms of using technologies. I mean, you mentioned signatures, right? So e-signatures and things like that to get things to market much more quickly. And then once things are, we've completed a trade, the transparency around all of that. And hopefully we can start using that to the positive side for beneficial owners, for our clients, kind of what is happening during the voting cycles and things like that. So that's what I would say kind of coming in, but I've certainly joined at an interesting time.
You have indeed. There's lots of lessons to be learned here. So I'm just going to pick a question that come through while we're having this discussion, and just comment on I suppose expectations of what the market is going to do over the next period. Yeah. So recent data said that global securities lending revenue is down almost 14%. How is the market expected to perform in the second half of the year? And just to put it in perspective, yeah. So we came in Jan 1st with a lot of expectations. We had people just got paid the bonuses. We were all expecting to see a certain amount of revenue from business. The world exploded a certain amount. Volatility got very high. Revenue from all different directions changed. And I'm probably going to start with Mr. Brunette, and just from a beneficial owner perspective. I mean, you're seeing the impact of all of the demand cycle come to you. How has your aspect changed? What do you think is going to happen in the second half of the year, if you could put your crystal ball in front of you right now?
Yeah, well, I think if you're only down 14%, you're probably doing pretty well. So I think the numbers we came up with were quite a bit bigger than that, but but that's all right. So hopefully someone's only down 14%. I don't know. We've been, like I said, we've been beating the drum. We've been conservative. We've had a view on risk and a view on pricing, and we're going to underperform in an environment where nobody else is pricing risk, or they're pricing risk at zero. So in a state where there's no belief in downside, yeah, we're going to be less than 14% down on the year is what I would say to that. What I think will happen, albeit I don't think it's going to happen in the second half of the year. I'm a huge believer in the secured lending model. I think it survives and it reinvents itself. But I think and I hope that lenders will wake up and realize that they don't need to be price takers. I think they'll develop an informed opinion on an adequate compensation for risk. And I think to Matt McDermott's point, I think there will be more interesting variations on the same types of trades. In a hugely volatile environment, his assets and liabilities are moving in different directions, and he has to find a way to manage that. And as a lender, we want to develop products to accommodate that, but there has to be some flexibility in it on our side as well. So I think technology, bringing kind of everything together, the tri-party side, the agency lending side, that I'm hoping that we can get out of this sort of static haircut model that every risk is priced at the same thing, and we can get into something that's a bit more dynamic, much more in line with a PB type of internal model of pricing risk that lenders can start to look at. That a 5% haircut and a 20 basis point spread isn't the right compensation in every market environment. So 6 months seems a little ambitious to get there, but I think hopefully at least people use the rest of the year to think about those types of things.
Agreed. And so I'll throw some of those points across to Ben and Rebecca, I think, in their role. So What can agents do better to help facilitate access to markets? Is there better infrastructure? I'm going to throw the CCP word out there a little bit. Are there reasons it needs to exist? It's sort of never been fully adopted in the SEC lending environment as much as some people would have expected. More embraced in the repo world. So what can we do? What can the agent lenders do to better facilitate market access to help?
You gave a little kind of perspective of where we started the year. You didn't talk about regs, and now we're not going to end like in the last 6 minutes talking a lot about regs, but they are still on the horizon. And I think there's two important points to make out of this. One, that as we've talked about, costs are going up as much as we could perhaps mitigate some of those costs with a different office footprint going forward. They are still going up in terms of servicing the business and the amount of flow that's going through. But they're also going up, more importantly, for our clients, such as Matt Brunette and others who are now having to grapple with things like uncleared margin rules for the first time and having conflicting uses of their securities. Rather than just putting in a lending program, lending them out the door and hopefully getting a return, now we're thinking about, okay, what's the cheapest to deliver collateral? It's the stuff that the broker dealers have had to do for time eternal. And so that's where I think the role of an agent can start to evolve, where the buy side has not particularly had securities lending and collateral management as their core competencies, and nor should they. Is there a role for the agent to be able to facilitate those type of transactions? So it's not just about putting stock on loan. It may be about borrowing stock. It may be about borrowing cash. It may be about lending cash. And I think that's certainly what we at JP Morgan are building towards, to have an agency platform that helps clients facilitate to their requirements. That's where I think this business is going to go in very short shrift, because of A, what we've seen most recently, but B, that there was a trend that was already out there. And I just think these recent events are going to exacerbate and accelerate people's views to achieve their goals.
Agreed. I think I would echo that, 100%. In terms of what can agents do better for their clients. We've talked a lot about what are we doing around the transparency of the trades, and I think applying performance analytics to that, and then a lot of providing that information to clients as well. I think you could apply that in a number of different ways. Not only performance of the stocks on loan or the choice of which stocks are on loan, but the best use of different pieces of collateral. As Ben mentioned, uncleared margin rules, different things like that, certainly throw into play a number of different uses for various pieces of collateral. What's the best use of that? Applying analytics to help make those decisions as an agent, I think is the way forward. And I think, couple that with performance in general of the actual stocks out on loan, or, various assets out on loan. I think that's kind of the winning combination. So staying with the technology theme, but really applying it to specific portfolios and the various potential uses for that is where I'd like to see us go even more.
Okay, so and thank you, Rebecca. We've got 4 minutes left, and I just want to, I think just think about the following task, and we can go around all of you. What do you forecast will be the biggest transformation in our industry in the next 5 years? What does the industry need to be better prepared for? And maybe I can start with Mr. McDermott.
Well, I think a continuum of kind of what Ben was kind of talking to, and also kind of with one of my new hats on now, I've taken over the digital assets team at Goldman, and I do feel that we will see, as things do kind of accelerate in terms of making the products more fungible, be it for UMR, for traditional securities lending, or for kind of other needs. And so, one of the things we're spending a lot of time in is looking at the digitization of kind of, securities finance, repo, intraday transactions. And I think in kind of, in reasonably short order, which is 2 to say 5 years, you'll see a big transformation. And that, with Ben talking about increased costs, hopefully that will kind of offset some of those costs just through kind of less friction, kind of atomic settlement, less collateral moving around the system. And so, we're spending an awful lot of time on that as well. Okay,
thank you, Matt. 30 seconds each, I think. Rebecca.
Yeah, no, I agree 100%. Digitization, we have to see it. Ben alluded to the costs. that's definitely been one trend in one direction. I think we have to embrace the technologies to help reverse that trend and make some of these other more kind of interesting things that I was talking about, analytics and stuff like that, kind of doable and affordable.
Thank you. Mr. Burnett.
Yeah, I think I'll stick with just general infrastructure. I think agents, collateral agents, lending agents, and prime brokers, they're all intermediaries. They're a route to market, but they provide an important infrastructure. And I think people like ourselves see how we can develop that infrastructure with them to achieve our end goals. I think repo is a great example. There were liquidity problems there, and there were solutions to provide more peer-type connections through the infrastructure that's already available. You have to pay for that, and you have to be a part of development of that, but it's there's a way to reinvent that same structure to move this industry forward.
Okay.
If that's clear enough.
Yeah, that's very clear. Thank you. Ben, you've got the last voice.
Thank you. Look, it's really just to reiterate what's been said, accelerate many of those same themes that we've talked about today, use these events as the driver for change. And that's not just technology and infrastructure, but it's connectivity, it's diversity. That's what we started talking about right at the start. And just to leave you with a saying, right, good sailors never learn on calm waters. So we're all going to come out of this, hopefully, in better stead than we went in, and are better equipped for the future.
Okay, I'd just like to finish this by saying thank you all. It's been an interesting discussion, certainly for me. I hope the audience have enjoyed it. We had about 300 people, hundreds of people listening to you. So appreciate all of their time in attending. I look forward to the rest of the events that Global Investor ISF and ISLA have for the next few weeks. And hopefully it was a good kickoff for everyone. So look, thank my panelists very much, and signing off. Thank you all.